right? So the learning objectives that we have here include a description of what it means to apply the decision usefulness approach, how we apply this theory to a single person in the context of an investment decision. We will talk about the principle of diversification. Can we increase the decision usefulness of financial reporting? And if so, how? Um, how have professional accounting bodies responded to the decision usefulness approach? And what are the broad implications of this approach for us in accounting? Those are some of the things we'll be looking at. So starting with what the decision usefulness approach is about. In a nutshell, we try to answer two questions. Who does accounting exist for? And what is the information that the users need to make their decision? Traditionally, when we answer the who do we exist for, that question tends to be answered with reference to investors and creditors. However, there's been a push towards including stakeholders in general. Stakeholders are parties who may not have made an investment or have lent money to the company, but whose lives and well-being are affected by actions taken by the company. Right? So one could argue society at large would be included in such a description of stakeholders. And to answer the second question, what are the decision needs of these users of financial information? We have to get inside of the heads of individuals and see how is it that people think of information. What does it mean? When does data become information? Not all data is information. So when does data become information? And so we try to answer that question, and if we are able to get that question answered satisfactorily, we can then tweak our financial accounting numbers to fall in line with users' needs. So starting then with the description and application of decision theory. The decision theory says when it comes to probabilities about what will happen in the future, there is no way for us to come up with probabilities that are objective and can be relied upon by everyone. There is no such thing. So every person, every single person will have their own gut feel, their own subjective outlook to life, right? About what might happen in the future, right? And every person has a has a different place from where they're coming from. Some of us are naturally more risk taking. We are naturally, and a person that takes more risk tends to be naturally more, one could argue, more of an optimist. Looks at a glass and considers it, half full instead of thinking of it as half empty. People who are more risk averse, it's not as if you know they're not cowardly or anything. It's just that they don't like the idea of embracing risk because they tend to be a little pessimistic in terms of their outlook to life. They think if things can go bad, they will likely go bad. And you need both kinds. In financial markets, you have people, you have bulls and bears. You have people who expect things will get better, and then there are people who expect things will not. And you need that diversity of opinion. If everybody believe that things are going to get better, 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 then you will get what's called a momentum towards a certain type of outcome. That's not good. You need other people with a contrarian view. Okay, so these state probabilities that you're dealing with tend to depend on an individual. But we also make an assumption that people are willing to change their initial expectations when they are faced with more information. So the role of information is either to confirm what an individual was thinking or to provide contrary evidence so that the person that's going to make the decision can adjust their initial expectation. So that requires an assumption about the people who make decisions as well. We assume that the decision makers are rational. They are looking to maximize their utility or sense of well-being. But at the same point in time, they're risk averse, i.e., they're not actively looking to take on risk. It doesn't mean that they will not take on risk, but they want to avoid taking unnecessary risk. So, given the same set of outcomes, an investor will likely go with investments that are lower on the risk profile but higher on the return. And we know that there is a trade-off between return and risk, and we will address that. So assume that individual decision makers are rational, they're looking to maximize their utility, and they're risk averse. And these things will they have a role to play in our application of decision. So first of all, what do we mean by a rational investor? A rational investor is one whose actions are predictable. So in microeconomics, an example might have been given to you. So if say there is an individual that says, I like Coke over Fanta, right? I prefer Coke to Fanta. And I prefer root beer to Coke. So if that is the indication that the individual prefers Coke over Fanta and they prefer root beer over Coke, the implication is that this person will prefer root beer over Fanta because root beer is preferable to Coke and Coke is preferable to Fanta. So we can kind of give an indication about the person's preferences based on the ordering or hierarchy of their of what they like. If this person now turns around and says, no, I would prefer to have a Fanta over a root beer, then you're dealing with a person whose preferences are difficult for us to map. So we want someone who will not change their preferences on a whim. We also are assuming that the person is willing to spend time to think. They don't allow emotions to take over. A rational investor will not allow emotions to take an upper hand in their decision making. They would rather think through, they would consider all the information that is available, and they'll try to make the best possible choice. And when making the best possible choice as far as an investment decision is concerned, they want to maximize their sense of utility, right? They want to maximize their well-being. They don't like to take unnecessary risks. So they will consider how much of risk they have to take to what their expectation of profits are. And their utility, their sense of well-being is linked to the profits that they can make from the investment. With that in mind, what are the types of utility functions that we can see? A risk-averse utility function will have something of this format. So notice, as profits increase. So the payoff is on the x-axis, and the utility is mapped on the vertical axis, the y-axis. So as my profit increases, the amount of utility or a sense of satisfaction, well-being, pleasure, etc., whatever, in whichever way you think utility works, my utility goes up as my profit goes up. However, the rate at which my profit goes up and the rate at which my sense of well-being goes up is not necessarily constant. You'll find that as a person makes more money or more profits, they do feel happier. But it's not to say that they will feel twice as much happy if they made twice as much a profit. So the rate of increase in happiness or utility, it diminishes over time, right? You see this kind of a function. There is a marked increase initially, but gradually that flattens out until at some future point in time, extra money doesn't really, or extra profits doesn't really mean a marked increase of happiness. So this is what you will typically see as being the risk, the utility functions. If you had to map it out as a mathematical function, a risk-averse utility function will typically take the shape of a square root or a logarithm. Okay, you will see an increase, but it tends to flatten out over time. In contrast, if a person was risk neutral, and one could argue risk neutrality would be, you would expect to see that amongst bankers because they make lending decisions all the time. So bankers tend not to become emotional. They will always evaluate all the information and they'll make judgments, and they know that some of the loans they'll make will not work out, they will turn bad, and they're okay with it. So they tend to have this very straight linear utility function, right? Higher the payoff, higher is the utility. So that tends to be linear. In certain extreme circumstances, you will find a risk-seeking profile. Now, I don't have a graph for that, but these are people that get thrills from taking on more risk, right? So these are your proverbial bungee jumpers, right? So people that'll go out and do daredevilry because they get an extra thrill. So for them, the rate of the utility goes. So instead of the I don't know if you're able to see the screen. So instead of the utility going up and then the rate of increase diminishing over time or with greater payoff, a risk seeker's utility function will go the other way, right? It will be convex. So this utility function is called a concave function, right? It kind of tries, see. So if you think about it, if you're almost looking at a profile of a cave, right? Concave, but on the other hand here, like the convex function goes the other way, right? You get a much heightened sense of utility with more payoff, and that would be a risk seeker's profile, which we would not typically associate with a rational decision. Okay, so in general, those are three risk profiles. We will encounter typically a risk neutral investor, or more logically, we will encounter a risk-averse investor. A risk-averse investor has a concave utility function. A risk-averse utility function would be linear, straight line. Now, when you're doing math for an individual investor, we will be using something called a payoff table, right? So payoff table associates what actions an individual decision maker will take, or rather what the outcomes of actions taken by an individual decision maker are, depending on what state of nature is realized. So over here, if the economy does really well, right? If the economy is in a high state, as an individual investor, if you bought shares and the economy does really well, you could end up with a profit of $2,000. On the other hand, if the economy does poorly, or say if the state was whether the company that you invested in does really well, right? If the company is successful, you'll make a huge amount of profit. But if the company does not do well, you'll end up with nothing. On the other hand, if you bought GICs, guaranteed investment certificates, regardless of how the economy turns out, you will make a certain set amount of income. And of course, if you look at the amounts involved, you know, there is really no comparison. GICs, you're getting a guaranteed amount, but it's only $100, as opposed to the payoff could be as much as 2,000. That's 20 times as much return as you can get if you invested in shares rather than GICs. So when, of course, the rational investor makes the decision, they have to account for the fact that buying shares is a much riskier alternative, right? And they will assess whether they are better off investing in GICs or they are better off investing in shares. Now, in order for them to decide, there is a concept of information system. So it's information is considered to be evidence that can affect an individual decision maker's action. An information system, it's presented in the form of a table, which gives you the probability of each possible evidence item conditional on the state of nature. So over here, if we were try to infer what's really happening by looking at financial statement evidence, if companies are presenting good news in their financial information and the economy is doing well, we should expect to see a lot more companies presenting good news when the economy is doing well than companies presenting good news and the economy is actually doing poorly. At the same point in time, even when the economy is doing well, there can be companies that are reporting bad news in the form of lower earnings numbers. But you will see a much stronger likelihood that companies will report bad news when the economy is actually doing poorly. So main diagonal is these probabilities that you're seeing, you know, from the northwest quadrant to the southeast quadrant, right? This main diagonal, which captures whether a piece of information can be looked at as providing evidence on what the current state of nature is, or what rather, you know, the current state of nature is not what we are interested in. We try to use financial information to predict the future. So can we look at the current earnings numbers as an indicator of what's to come? So there we talk about something called earnings quality. So these values that we have around the main diagonal, if we see the main diagonal values as being more than 50%, then we'd say the information system is high quality. It gives us information, gives us good quality information. If on the other hand, these main diagonal values are just 50% or below 50%, that we say they are low quality. There's a lot of noise. Because for us to say, oh, there's a 50% chance that the economy might do well next year, that's like flipping a coin, right? If I flip a coin, I could get heads, I could get tails. You got to do better than just flip a coin, right? So when you look at financial information, companies try to increase the relevance of their financial statements by providing supplementary information, right? So you might have heard of management discussion and analysis. Companies provide additional information that's not encapsulated in their financials. They provide supplementary disclosures, etc. The whole point there is to make sure that they are increasing the usefulness of their financial numbers without sacrificing reliability. Now, again, just to show you that main diagonal number one more time here, if you see an information system that looks like this, good news is 80% correlated with a high state of nature. Bad news is 90% correlated with a low state of nature. You see the main diagonal probabilities are very high, definitely much higher than 50%. You will conclude that this particular information system is high quality. Had our numbers all been close to 50-50, you would have said there's a lot of noise. And noise is not good when it comes to making decisions. So a question could be asked, why do we have off main diagonal probabilities of an information system being non-zero? So what I mean by that is over here, why is it, so if this were the main diagonal, right? 80-90 was the main diagonal. The off main diagonal probabilities are this 20%, 10%. So why is it that when the economy is in a high state, 80% of the companies are reporting good news, but you get 20% of companies that report bad news? Why do we not have 100% of companies report good news? And when the economy is in a low state, why is it that we only get 90% of the companies that report bad news? How come there's 10% of companies that potentially report good news? Why are these probabilities that are not on the main diagonal, so the off main diagonal probabilities, why are they not zero? Why do we have some positive values for these off main diagonal probabilities? What might be the reason? And can we answer that question with reference to relevance and reliability? So a suggested answer would be that if I'm looking at the main diagonal here, right? So if I'm looking at the main diagonal, so let's say I had an information system that went something like 0.5, 0.5, 0.5, 0.5. My main diagonal is this, right? 0.5, 0.5. I got this one as being my main diagonal. If I'm trying, let's say, good news, bad news, high state of nature, low state of nature. if I have an information system that goes something like this, I can't really make any conclusion. So, if you gave me an annual report of a company and I go through it and say, oh yeah, this company is reporting good news. Does that mean the economy is doing well or is going to do well? If I look at the probability, I'm seeing good news, and I'm saying, given good news, 50% probability that the economy will do well, 50% probability that the economy will not do well. Not really getting anything out of that piece of information there. It's only when, say, if I got something like this, that if I read good news in the financial statements, that is a harbinger, that's an indicator that the future is going to be better. Then I can say, okay, given here the fact that I'm reading good news in the reports, I can expect that the economy is doing better or will be doing better. There's a much higher likelihood that the economy will do better. Now, the reason that I don't see something like this, that 100% good news is related to a high state of nature, and bad news is 100% related to a low state of nature, is because we don't operate under ideal conditions, right? We don't operate under ideal conditions, and that is why there are times when our relationship between the information and the state of nature breaks down a little bit. The higher these probabilities are, though, on the main diagonal, the more relevant our information is. If you consider the off-main diagonal probabilities, they are the necessary errors of estimation that are brought in. So when can it be that a company reports poor numbers even though the economy is doing well? Well, that could be because the company itself is being poorly run, right? A company that has either suffered massively on account of some specific misfortune that befell the company, but in general, everybody else in the market is doing well. Well, that can tell us information specific to the company, right? Or it could be the result of poor management, right? The whole economy is doing well, but that specific company is doing poorly. Or it could be that a company is so well run that even when the economy is in the doldrums, this particular company is doing well, right? So that, again, would be an exception rather than the rule. So when you don't exist, when you don't operate under ideal conditions, you get noise creeping in. The off-main diagonal probabilities are the noise that is inherent in any information system. However, the higher you have for the main diagonal probabilities, the more relevant the information system. And not only relevant, the high probabilities here, the high correlations, also enhance the sense of reliability of the information. Okay, so both relevance and reliability are heightened when you have high main diagonal probabilities. And I believe there is a similar question in the textbook that you can read up the textbook author's answers. They give you long, one-page long answers. I just gave you a summary. Why is an information system more useful the lower the off-main diagonal probabilities are? Well, like I mentioned, these off-main diagonal probabilities are noise. The lower they are, the less noisy the information system is, which means the more relevant and reliable the information is. Okay, how do we now apply this concept to an individual decision maker? I think we're hitting 8:30, so maybe we should see a question that helps us digest that. We have this investor here. Now I've just given you the snapshot. This is a question taken from your textbook. I believe we have the textbook here. And conclusions on decision usefulness. Here we are, Mr. Smart. So Mr. Smart is an investor with $15,000 to invest. Let me just copy the question so that we can work through it together. Mr. Smart. So Mr. Smart is an investor with $15,000 to invest. He has narrowed his choice down to two possible investments. Either put his money in a mutual fund or buy common shares in Buy Me Corporation. Now this picture here gives us a decision tree for Mr. Smart's situation. Mr. Smart is risk averse. The amount of utility he derives from a payoff is, utility is 2 times the natural log, ln stands for natural log of the payoff, where ln denotes natural logarithm. Because of a planned major purchase, Mr. Smart intends to sell his investment 1 year later. So we're looking at a 1 year decision outlook or 1 year investment outlook. The payoffs represent the proceeds from the sale of the investment and receipt of any dividends net of the initial investment. The probabilities on figure 3.5 represent Mr. Smart's prior probabilities about the state of the economy over the coming year. So when you look at the probabilities that Mr. Smart has assigned, is the economy going to do well or is it going to do poorly? Mr. Smart's prior probabilities. So you ask Mr. Smart, do you think the economy will do well next year? Mr. Smart says, I don't know. When you're going with I don't know, it's like taking a coin, flipping it, 50% chance of heads, 50% chance of tails, might be good, might be bad. Mr. Smart doesn't really know. So as far as Mr. Smart is concerned, he is unwilling to or unable to say for sure whether the economy is going to do well in the future or not. So that's kind of a sneaky way of saying Mr. Smart is maybe not that smart, or maybe Mr. Smart is very smart and accepts that as a mere mortal, he doesn't know, right? He doesn't know better. The question is, in spite of not being able to predict the future, can Mr. Smart decide whether he wants to buy common shares or he wants to buy the mutual fund? Got $15,000 to invest. The answer to that depends on what Mr. Smart's utility is expected to be from investing in the common shares versus investing in the mutual fund. That calculation is done based on Mr. Smart's utility function. Mr. Smart's utility function is, utility is 2 times the natural log of the payoff. So what are we looking at? We have payoff, right? So the action Mr. Smart has several possible actions. You have probability given, and you've got the payoff given. So from investing in common shares, right? So common shares is action being investing in common shares. The outcome depends on the state of nature. And as far as Mr. Smart is concerned, either the economy will be in a good state or it will be in the bad state. The probability as far as Mr. Smart is concerned is 50-50. And the payoff, if the economy does well, Mr. Smart's payoff will be 8,000. If the economy does not do well, Mr. Smart's payoff from investing in common shares will be just $1,000. As far as mutual funds are concerned, if the economy does well, the payoff will be $5,000. If the economy does poorly, the payoff will be $2,000. Now, utility is defined for Mr. Smart as being 2 times the natural log of the payoff. Natural log, ln, natural log of the payoff, 8,000 times 2, that works out to 17.974, yada, yada. Let's call it 17.97. The payoff, if the payoff is 1,000, the utility will be 13.82. If Mr. Smart invests in mutual funds, his utility will be natural log of 5,000 times 2. If the payoff is 2,000, Mr. Smart's utility is going to be natural log of 2,000 times 2, which is 15. What is the expected payoff? The expected utility. Get the expected utility, you got to multiply the utility from each payoff by the corresponding probability. There's a 50% probability that the utility will be 17.97. There is a 50% probability that the utility will be 13.82. So if I was to add together these probability adjusted amounts, the expected utility from investing in common shares is 15.89. If I do the math for investing in mutual funds, works out to 16.12. Now, Mr. Smart is a rational decision maker. He's risk averse, utility maximizing. Which action would you recommend that Mr. Smart takes? If he invests in common shares, his expected utility is 15.89. If he invests in mutual funds, his expected utility is 16.12. Which one should Mr. Smart take, given that he is rational, utility maximizing, and risk averse? You guys absolutely sure it's mutual funds, right? Mutual funds. Based on his prior probabilities, Mr. Smart will invest in mutual funds because his expected utility from doing so is greater than that from buying common shares. It's a very logical thing to do. Now, the problem in this scenario, though, is that Mr. Smart is not able to discriminate between whether the economy is going to do well or if it's not going to do well. Right now, he's not sure. That doesn't mean that Mr. Smart is an idiot. Mr. Smart just doesn't have enough information. Now, if Mr. Smart is rational, he should be willing to put in the effort to get more information, to do homework, to do research. If he does so, he should be able to find some information that helps him decide whether the probability of the state of the economy being good or bad is different from 50-50. Now, let's say if the probability, instead of being 50-50, just for the sake of argument, say the probability was, and I'm just doing it randomly, what if it was 60-40? There was a 60% probability that the state of the economy would be good. Now, what would you recommend? I just changed the probability to 60%. The expected utility from buying common shares is now 16.31 as opposed to 16.3. Now you will switch, right? Now Mr. Smart's answer will change. So information is relevant if it has the ability to change someone's decision. Now, it doesn't always have to be. What if the probability of the economy being good is actually only 30%? 70% chance the economy will do bad. Now what? Now your answer will be to buy mutual funds, but you'll be even stronger in saying, oh yeah, you should go for mutual funds, right? So information can still be relevant if it makes you more confident in your initial expectation, right? So it doesn't always have to change your decision. Information should either make you more confident in what you were initially thinking, or if it gives you something else to think about, then there should be a potential to change your outcome. So at this point in time, Mr. Smart does not know any better, and he's leaning towards investing in mutual funds. And the reasoning is, even though the mutual fund upside is not as high as investing in common shares. He invests in common shares, he can make $8,000 in profit. Investing in mutual funds, he will only make $5,000 in profit. When you look at the downside of it, from investing in common shares, his return could be as low as 1,000, whereas investing in mutual funds, the lower bound of his return is $2,000. So if you look at the span, the spread, investing in common shares, the returns range from 8,000 on the top side to 1,000 at the bottom. That's a pretty wide spread, $7,000. As opposed to mutual funds where the high mark is 5, but the low mark is 2. So the spread is only $3,000. So the variability of returns for a mutual fund is smaller, as opposed to a much higher variability for common. The higher variability makes the common shares more risky. Of course, if it goes really well, you can make a ton of money, but if it doesn't go well, you won't make enough. As opposed to mutual funds where you will make less money on the top side, but you'd also, you're guaranteed to make much better returns than investing in common shares, or you expect to get much better because of the diversity. All right, I'm not seeing any questions immediately, so let's move on and see if there's anything to be said about the importance of doing homework. So Mr. Smart decides that he will like to obtain more information about the state of the economy rather than simply accepting that it's just as likely to be good as bad. What he does is he takes a sample of current financial reports, annual reports of major companies. Now, the evidence that he's able to obtain is that every annual report that he picks up shows that the company is doing well. And profits have basically gone up over the previous year. The probability that there would be such healthy profits if the state of the economy actually was good is 0.75. So this is where your information system's coming in. So you're looking at evidence. So the evidence that we have is that the profits are high versus low, right? So evidence, financial statement evidence is good news or bad news. So if Mr. Smart is going through annual reports, looking just at the earnings numbers, to make a very simplified case, you could argue that good news here can be coded as being current year's financial profits, right? Current year's profits are greater than last year's, right? Increased profits in the current year as opposed to, and bad news would be the opposite, decreased profit. Now, our friend Mr. Smart has found evidence of good news. All the annual reports that Mr. Smart has seen have been, he's seen increased profit. So that's what he's going with. Now, with this evidence, Mr. Smart is trying to predict the state of nature, right? So the state of nature here there's two possible states of nature as well. We're simplifying it. It is possible for there to be more than two, but over here, just with the two, either, because for Mr. Smart, if you look at it, the two states of nature are good and bad. Right? So good is the high state, and bad would be the low state, if you will. Now, what we're trying to see is if we can set up an information system for Mr. Smart. Now, Mr. Smart's evidence, again, was that the annual reports are showing companies are doing really well with increased profits over the previous year. The probability that there will be such healthy profits if the state of the economy actually was good is 0.75. So there is a 0.75 probability, 75% basically, that when you see good news in the annual reports, the economy is actually doing really well. The probability of such healthy profits is only 10% if the state of the economy actually was bad. So when you see good news, when you see companies are reporting healthy profits, the probability that the economy is actually in or going into a recession is 10%. Okay. we don't have bad news. Mr. Smart has not seen any company reporting lower profits than the previous year. But there's always, in terms of probabilities, the probabilities add up to 100%. So the very fact that companies are reporting healthy profits, it doesn't guarantee, there is no guarantee that the economy is actually doing well. There's a 75% probability that it's true. But that still leaves us with a 25% probability that the economy is actually not, or rather, the economy is doing well, but the company does not report higher profits, because there can be certain circumstances pertaining to the company itself. Like um, if you look at last couple of years, almost all companies have been doing really well as opposed to marijuana companies. So cannabis companies have not been doing well. If you used the stocks or the annual reports of cannabis companies to say, oh, let's see if we can draw any conclusions about the state of the economy, that would not really be very useful. Like if you looked at other companies, other sectors, they've done much, much, much better as opposed to cannabis, right? So you can have companies that are reporting bad news, even if the economy is actually fairly healthy. But there's also the flip side to that evidence. We said, well, the fact that a company will report good news even when the economy is doing poor, well, that probability is only 10%. So what does that mean? The complement of that is that if you see companies reporting lower profits than last year, there's a much stronger probability that the economy is doing bad. That's 90%. If you look at the main diagonal probabilities are 75% probability that the economy is in a good state when the evidence is good news, and a 90% probability that the economy is doing poorly when you see bad news in terms of the annual reports. So this is the information system or the information table that we can prepare from the information that Mr. Smart has been able to collect from his research. Okay, so there's a couple of things that you need to watch out here. This information system is, first of all, the main diagonal probabilities are high. And when we say high, it's a value judgment, but certainly they are greater than 50%. And so you would argue that these probabilities are, so this information system is useful. Another thing to note is that even though both of these main diagonal probabilities are high, right, they're greater than 50%, we have a much stronger correlation between bad news and the state of the economy being bad, 90%. So if you see companies reporting higher profits, you're fairly confident that the economy is doing well. But you're even more confident of the fact that the economy is actually doing poorly if you see companies reporting bad news in their annual reports. So as the correlation between bad news and the low state of economy is higher than that between good news and the high state, we can say that this information system is more conservative. Now, you might recall the use of the term conservatism, right? Accounting numbers should be conservative. Like we should not overstate asset values. We should not overstate income. And part of the motivation for that is we don't want, through inflated numbers, users to end up drawing wrong conclusions about not just the company, but if they are trying to infer other things from the use of the financial numbers, we don't want people to draw bad conclusions, wrong conclusions. And so in case we have to err, we would rather err on the side of caution, right? We would sooner err on the side of caution. We would sooner report lower profits than we would overstate our profits. Okay, so over here, this information system is actually doing just that. It is conservative. If you encounter, or if Mr. Smart had found that the annual reports were, for the most part, reporting lower profits, he would very well have inferred that the state of the economy is bad, that it's in the low state. All right, now what's Mr. Smart going to do once he's done his research? He's not going to just pat himself on the back and say, oh yeah, good job, now let's go to sleep. Mr. Smart's actually going to use this information to refine his investment decision. At the end of the day, Mr. Smart's got money that he needs to invest, right? So Mr. Smart's going to revisit, he's going to revisit his investment decision. So here we have this notion of probabilities. So we talked about prior probabilities, right? Prior probabilities are what an individual's own subjective expectations are. Prior probabilities refer to an individual's subjective expectations about the future. And these serve as a baseline, right? So if you quiz Mr. Smart about where he's likely to put his money based on the inherent utility preferences that he has, and also considering the fact that he wasn't very sure about which way the economy was going to go, he is naturally inclined to invest in mutual funds. Now, there could be someone else who might naturally be more of an optimist and might think, oh, there's a 60% chance that the economy will be doing well, and only a 40% chance that it wouldn't. Or someone might be a natural pessimist and might say, oh, there's a 65% chance that the economy will be doing poorer, and only a 35% of likelihood that it'll do well. So prior probabilities serve as a starting point, right? So they serve as a baseline starting point for the decision makers' natural inclination. Now, the fact that the investor here was willing to go and obtain additional evidence, right? The fact that Mr. Smart was willing to obtain additional evidence indicates or supports our assumption that he is rational. Now, there can be some individuals who are wedded to their views and will not change. We consider that kind of a position that I'm not going to change my opinion no matter what, to be not a rational person. But you cannot reason with an individual who holds on to their views as if it was some kind of a religious belief. Like, you need someone who is willing to do homework, right? To go and obtain new evidence, new information. And if the new information is of sufficient quality so as to change or to lead the individual to change their expectation, you're willing to make the change, right? So over here, we're assuming that Mr. Smart is rational, i.e., he is willing to reconsider his opinion based on new information. Not everybody does this, okay? Not everybody does this. So this is a very important assumption that we have to apply with, that information will only be useful if someone's willing to use it, okay? So we have an additional concept called posterior probability. Now, posterior probabilities refer to an individual's expectations altered by new information. We had Mr. Smart starting out with a 50% expectation about the state of the economy, right? 50% probability it'd be good, 50% probability not good. Now that Mr. Smart has obtained new information, Mr. Smart should now incorporate this evidence. The evidence that he has is basically that of good news. This is the evidence that Mr. Smart possesses. And so Mr. Smart is going to now recap and revise his expectations. Okay, so how does that work? For Mr. Smart, we can calculate his posterior probabilities as follows. We use something called Bayes' theorem. Your textbook talks about Bayes' theorem. The calculation that your textbook uses is a little complicated, but it doesn't really have to be. All we got to do is we got to take Mr. Smart's prior probabilities and then his probabilities based on evidence. So we're trying to predict states of nature. States of nature are good or bad. Mr. Smart's prior probabilities were 50-50. He really did not know any better. Now, given that Mr. Smart has obtained evidence of good news, the probabilities related to good news are, there's a 75% probability that the economy is in a good state. When you see good news, 75% probability that the economy is in a good state, and only 10% probability that the economy is not in a good state. So what we now need to do is merge the two, Mr. Smart's prior probabilities and now the probabilities based on the evidence. You got to merge the two. So calculate the product of the two. 50% times 0.75, and then 50% times 0.1. If you merge the two, you get 0.375 and 0.05. If we add together these two products, we get 0.425. Now, think of it as a batting average, right? So out of 425 occurrences, 375 will lean towards good, and 50 out of 425 lean towards the economy being in a bad state. So posterior probabilities posterior means after the fact. So after obtaining new evidence, there's a 0.375 out of 0.425 probability that Mr. Smart will expect the economy to be good. If I calculate that, I get 0.88235, etc. In the question, I think they said round your calculation to 2 decimal places. Even if we don't round it, let's just reduce the visibility to something more manageable. Let's say posterior probability for the economy being in a good state is 0.8824. Of course, the total of probabilities will always be 100%. So the expectation that the economy will be in a bad state will just be whatever it takes to make the total 100%. For Mr. Smart, then, his posterior probability will be 0.8824 that the state of nature will be good because he's obtained evidence of good news, higher profits, and only 11.76% that the economy is actually doing poorly or going to do poorly. So now certainly his probabilities have changed, right? Mr. Smart's probabilities have changed from being 50-50 to something that's a little more discerning between the states of nature. We'll pause here and see if anybody's got any questions. The way I showed the math is quite different from that shown in the textbook. This is easier, I think. We take the prior probabilities again, and then we consider the information system that we have. And Mr. Smart has found evidence. Every annual report is showing that its firm is doing well with increased profit over the previous year. So that's what we got to go with. The probability, so we have to go with what does the fact that companies are reporting healthy profit mean? We have a 75% probability that the economy is doing well when companies report healthy profits, and only a 10% probability that the economy is doing poorly when such healthy profits are reported. So that is the probabilities based on the evidence. We merge the two by multiplying. So there's a multiplicative effect. Prior probabilities times the probabilities based on the evidence obtained. The product of the two sets of info that we have here gives us the total possibility of outcomes. And then posterior probabilities will just be the relative weighting of the individual product out of the total. So 0.375 is the product for good state of nature out of a total of 0.425. So 0.375 divided by 0.425 is the posterior probability that the economy will be good. And 0.05 over 0.425 gives you the probability that the economy is doing bad, even when the financial statement information indicates good news. That sort of okay, or any questions? Any part that didn't quite click? Folks doing all right? Kyle's asking, would it be specified in the question for which one to use? Could you elaborate a little bit on that, Kyle? Like when you say which one, what are you referring to?
Can you hear me? I'm just trying to make sure my
Yeah.
mic works. Like just between like posterior and just like prior probability, because you've kind of given us two,
Mhm.
or are they considered kind of the same? You just use information differently.
Well, okay, that's a fair question. So if Mr. Smart has gone and obtained new information, we expect that Mr. Smart will take that new information into consideration. And that's where, sometimes things fall apart. Sometimes, there are people who are so convinced that they are right, that even in the face of information that's actually opposed to what they're thinking, people start ignoring information. Like they say, no, it's not, I am firm in my belief that this is right. You can give them as much of additional information as you want, but they're not going to budge. So for them, their posterior probabilities are going to be exactly the same as their prior. They don't change. Whereas for us, our characterization of a rational investor is one that is not wedded to his or her beliefs, that is willing to obtain new information, and once he or she has obtained new information, is willing to alter, amend his or her expectations based on the information. So in this particular case, we were asked a before and after sort of a question. So if Mr. Smart has not done any research, well, then what's his baseline inclination? Well, his baseline inclination is that he would go and buy the mutual fund. His utility is expected to be greater from investing in a mutual fund than it is from investing in common shares. Now, though, that Mr. Smart has gone and done homework, could that change? Should that change? So that's for us to determine now. We're going to have to redo this math, right? We're going to redo this math. So Mr. Smart's decision still depends on his expected utility. And that relates to the two investment choices that he has of buying common shares versus investing in mutual funds. We were initially using Mr. Smart's prior probability. Now, since Mr. Smart has done more work, we will replace Mr. Smart's prior probability with his posterior probability. So his posterior probabilities are 0.8824 for the economy to be in a good state, 1176 for the economy to be in a bad. Mr. Smart's payoff from investing in the common shares was 8,000 if the economy is in a good state, $1,000 if the economy is doing poorly. His payoff is 5,000 from investing in mutual funds if the economy does well, and 2,000 if the economy does poorly. We will calculate Mr. Smart's utility from each of these payoffs. Mr. Smart's utility curve was defined as twice the natural log of the payoff. So it's 2 times the natural log of 8,000. So 2 times the natural log of 8,000 gives us 17.97. So if I just make it more manageable, it's 17.97 is utility from $1,000 will be 13.82. And that's the same numbers that we had up here, right? So those are simply the amount of utility from each of the payoffs. For the expected utility, what we do is we calculate a weighted average. The weighted average is computed by multiplying the utility by the probability. There was, before Mr. Smart and Mr. Smart's estimation, there was a 50-50 chance that the economy would do good versus bad. So 50% times 1797 gave us 8.99. Similarly, 50% times 13.82 gave us the 6.91. Added together, we got the expected utility from investing in common shares. And likewise, we calculated the expected utility from mutual funds. If we now calculate the expected utility, since our probabilities have changed, so now we are looking at 15.86 plus 1.63, which works out to 17.49 from investing in common shares. And the utility expected from investing in mutual funds is 16.8. So if you compare that to the expected utility numbers from before, both have gone up, right? Both have gone up. Like the expected utility from investing in mutual funds was 16.12. Now it's 16.82. However, the utility expected from investing in common shares is now higher at 17.49. Right? So both went up, and now in comparison, the expected utility from investing in common shares is more than that from investing in mutual funds. And remember that since Mr. Smart is a utility maximizing individual, he will change his decision now. Instead of choosing to invest in mutual funds, he will now go with common shares. So our conclusion here would be Mr. Smart will now choose to invest in common shares. Makes sense?
Yeah, that makes sense now. I guess my brain's just a little, it's a long day at work and then coming to learn.
All right, I'm glad that makes sense. That's awesome. Okay, so what I'm going to do next is put you folks in a bit of a spot and actually make you work through a question. You don't want people to feel like they have to do it on their own. It's best that you work on a group. And the reason for that also is that you have a group assignment to expect in a couple of weeks' time. So we need to form groups, and we won't know who we want to work with unless we've actually had some experience working with individuals. So what I'm going to do is put people in random groups of 4 or 5 individuals. And what I would like you to do is to work on problem 311. So there in this file. What you would need to do, since you're not allowed to make any changes to this file that I've shared with you, what you need to do is click on File and make a copy or download a Microsoft Excel version. And then I want people to work together, collaborate. I'm not going to give an excessive amount of time, but I still want to give enough time for people to say hi, introduce themselves, kind of get a sense of at what stage in the course or in the program, I'd say each one is, and see if there's any interest in working together. Okay. And then for another activity, I'll maybe reformulate groups, or we'll see how it goes. So I am going to send you folks into random groups. I will come check in on how the groups are doing. But that's just to be available as a resource. It's um, not to enforce any kind of compliance or anything. So kind of played by ear. It's 6:41-ish based on my clock. I'm going to give you folks until 10 after 7 to work together. And then we'll take up the answer together. Does that sound like a plan?
Sounds good.
All right, so let's see. Breakout. So I made a few notes while you folks were working together in the breakout rooms. Our friend Marie has $1,000. This could very easily be $1 million. So the numbers, the fact that the amount is small should not distract us from the decision. We're told that there's two actions that Marie can take. She can buy bonds of risky mining or buy savings bonds. Now keep in mind, there can be more investment alternatives as well. 2 actions is not like you could also have 3 actions. It's a big deal. We'll be essentially evaluating these options along the lines. Okay, so have I not shared my screen or? Oh, the Google Sheet link. Okay. Here, just give me a sec. The link is also there on D2L, just so you know, in case you happen to lose it, it's there on D2L. Okay, so 2 choices, risky mining bonds or savings bonds. There is a big disparity between the returns, possible returns. Risky mining pays 14.4% interest. Savings bonds only pay 6.4%. So it's quite a bit of a gap. But of course, investing in risky mining will expose Marie to the risk of risky mining going bankrupt. If that happens, she would lose her principal and interest. Marie feels that there's a 40% chance that risky mining will go bankrupt. That's based on Marie's prior probability, her attitude or outlook to life. The savings bonds will pay off regardless of whether risky goes bankrupt or not. Marie's utility for money is given by the square root of the amount of her gross payoff. So in case you're wondering, why did they go with gross payoff here? Well, the reason is that if Marie invests $1,000, and if, let's say, risky mining goes bankrupt and she gets nothing, the net payoff for Marie will be a loss of 1,000, so negative 1,000. And when you're looking to calculate the square root of a negative number, those are imaginary numbers. So square roots of negative numbers are not defined. Since Marie has a square root utility function, we are going with her gross payoff, which is what is the amount she gets back, principal plus interest. If she loses both her principal and interest, well, in that case, Marie gets back nothing, which is still a positive, like zero is still, you could consider zero as a positive number. Square root of zero is zero, right? So it's just to allow us to be able to do the math that the utility function is described as a square. The classic ones are logs or square roots. Now, the second piece is in my little chart that I posted, I put in the gross payoff numbers. You might be wondering, where did these come from? How did we get the payoffs? The payoffs are nothing but the total of principal and interest. So if risky mining, if Marie invests in risky mining and risky mining is not bankrupt, Marie will get back her principal of $1,000 plus interest at 14.4%. That's another $144. That's the sum of the two is the gross payoff of 1,144. From the savings bonds, the principal is 1,000. Interest at 6.4% would be $64. That's how we get 1,060. And based on Marie's prior probabilities, there's a probability of 40% that risky mining will go bankrupt, 90 or 60% probability that it will not go bankrupt. And I laid it out not bankrupt, bankrupt, because when we look at the information system later on that Marie prepares, the future states are laid out as not bankrupt and bankrupt. So I kind of was consistent there, not bankrupt, bankrupt. In the case of savings bonds, the savings bonds will pay regardless. So the possibility of savings bonds going bankrupt is not applicable. Savings bonds will pay $1,064 regardless. So some of you can, in fact, you can dispense with this piece. You can just go with not, because savings bonds will pay regardless, right? So it doesn't depend on bankruptcy, not bankruptcy. This is almost like a guaranteed payment. Think of it as a GIC, right? You're getting the guaranteed return, so 100% probability or 100% likelihood or whichever certainty that you'll get $1,064, square root of which is 32.6. Now, when you compare the two, certainly 32.62 takes the cake. Marie will, based on her prior probabilities, Marie will choose to invest her money in the safer option of savings bonds. And I went and looked at a couple of groups, and you folks seem to agree with that. Does everybody, all the groups agree with it, or did you guys have any other takes on it?
Sorry, can you just scroll down to the calculation part again?
Yeah, absolutely. And mind you, you can scroll at your end as well, just so you know. If you're sharing the file, you should be able to, if you click on the link, it'll open a Google Sheet and you should be able to navigate at your end. You're just not allowed to make any changes to the file. Just to walk us through here, for risky mining bonds, there's two possibilities. Either risky mining goes bankrupt or it doesn't. If risky mining goes bankrupt, Marie gets nothing. Square root of nothing is zero. If risky mining does not go bankrupt, and there's a 60% probability that Marie is assessing for it, payoff will be 1,144. And since Marie's utility is defined as the square root of what she gets back, square root of 1144 is 33.82. The formula is SQRT. So square root, and then you can select the dollar value there. So that's what I did. That's 32.82. Expected utility is Marie's probability multiplied by the utility. So 60% times the 33.82. That's what gave me 20.29. In the case of bankruptcy, Marie's getting nothing, so 0.4 times nothing. Now the question could very well have said if Risky Mining goes bankrupt, Marie won't get her interest and will only be able to recover 50% of her principal. Well, in that case, the payoff will be 50% of $1,000, $500. So there could be some positive payoff even in the case of bankrupt, right? So it totally depends on the facts provided to us. The savings bonds are guaranteed. There's no, well, 100% is a certainty that the payoff will be $1,064. Square root of that is 32.62. 32.62 is more than the 20.29. Hence, Marie is expected to invest in savings bonds for now. Okay. Right, then moving on. Before making a final decision, Marie decides she needs more information. She obtains Risky Mining's current financial statements and examines its debt to equity ratio. Debt to equity ratio, as a reminder, is total liabilities divided by total equity. And the higher the debt to equity ratio is, the more vulnerable the company would be to possible bankruptcy, right? So you want your debt to equity ratio to be low. This ratio is either high or low. Now, what is high and what is low, again, would depend on the interpretation of the user. Okay, so over here, it's got to be Marie's interpretation. Upon calculating the ratio, Marie observes that it is low. So Risky Mining's debt to equity ratio is low. On the basis of her prior experience in bond investments, Marie is not a newbie here. Marie is fairly sophisticated. She has made bond investments in the past. She's able to rely on her experience. And based on her prior experience, Marie knows the following conditional probabilities. And what are these probabilities conditional on? It's basically the debt to equity ratio. So for a company that has a, right, look, you can read it horizontally better, I would say. For a company that won't go bankrupt, the debt to equity ratio could be high, could be low. It's hard to say, right? Because there could be other factors. Debt to equity ratio is but one such factor that will impact a company's possible bankruptcy. So the fact that a company did not go bankrupt cannot really be predicted by looking at its debt to equity ratio. You see a more definitive leaning with regards to companies that do go bankrupt. For companies that do go bankrupt, 95% of them would have had a high debt to equity ratio. Only a small 5% of companies that went bankrupt would have a low debt to equity ratio. Right? So bankruptcy could be triggered by other reasons, but it's in a very, very, very small proportion of such companies. Now, keep in mind that Marie has only found, the piece of evidence that Marie has is that Risky Mining's debt to equity ratio is low. So we can only go by this piece of information. When a company has a low debt to equity ratio, there's a 50% probability that it will not go bankrupt in the future. and a 5% probability that it will go bankrupt. So as far as Marie is concerned, this column here for the low debt to equity ratio, that is her evidence. Right, so we're going to recalculate Marie's probabilities. So we are looking at the evidence, and we've got the evidence. We're going to recalculate Marie's posterior probabilities. How will we do that? So prior probabilities for Marie was that Risky Mining has a 60% chance that it will not go bankrupt, 40% chance that it will go bankrupt. Now, probability based on evidence, and the evidence is a low debt to equity ratio. The probabilities are 50% that it will, or 5% that 50% that it will not go bankrupt, and 5% that it will go bankrupt. If we multiply the prior probabilities by the probability conditional on the evidence, so 60% times 0.5, that gives you 0.3. 40% times 0.05 gives us 0.8. If I add together out of 32 chances, or 320 chances, whichever way you want to look at it, 300 out of 320 chances, Risky Mining is not bankrupt. 20 chances out of 320, Risky Mining will go bankrupt. So posterior probabilities is basically the product of Marie's prior probability and the conditional probability based on the evidence obtained. So 0.3 divided by 0.32, the posterior probability that Risky Mining will not go bankrupt is 0.9375. The posterior probability that Risky Mining will go bankrupt is 0.0625. Everybody okay with this calculation? Right. Now we're going to recalculate. So recalculation of the savings bonds number won't change, right? Because the savings bond payoff is guaranteed. All that's now going to change is the calculation for Risky Mining. The prior probability for Risky Mining not going bankrupt is 0.9375. Not the prior, posterior probability, I should say. Using posterior probabilities, posterior probability that Risky Mining won't go bankrupt is 0.9375. The payoff is 1144. Calculate the square root of it, multiply by the probability. And you know what? In spite of such a big jump up, the expected utility from investing in Risky Mining bonds is still not enough. Still not enough to bump out the GIC. Marie will still go with the savings bonds because we expected it to be higher. Now, this differs from our earlier example where we got Mr. Smart to change his decision, right? Mr. Smart changed his decision from investing in mutual funds to investing in common shares. So something important to note about information. In order to be useful, information does not always need to change a user's decision, right? Look, Marie is not a newbie, as I said. Marie has experience investing in bonds in the past. So the fact that her starting prior probabilities were not like, I don't know, 50-50, she did have a more refined expectation about the risk of bankruptcy, right? For her, it was 60% not bankrupt, 40% bankrupt. So an individual user will not always be naive. They may have some prior experience. And based on prior experience, their prior probabilities might be different from 50-50. So now what makes information useful to such a person? It doesn't always have to result in a change in their decision, right? So that's not the criterion to apply when assessing if information is. What we should see though is useful information should bring about an improvement an improved ability to distinguish between the decision alternative. If you consider the case of Marie, in Marie's case, her prior probabilities were 60-40. Using the information, Marie's posterior probabilities were enhanced to 93.75. Right, so certainly she's able to better distinguish between the two likely outcomes, right? So whether bankruptcy will happen or not, before obtaining the information, Marie was sitting at a 60%, 40% chance. After obtaining the information, Marie's strength in her conviction, if you will, is much improved. She's 93, almost 94% confident that Risky Mining will not go bankrupt. And in spite of that, she doesn't change her decision because it's just that it's still too risky. Investing in Risky Mining is still too risky. The reward from investing in Risky Mining does not outweigh the risk of possible loss. Right? So a question could be added over here. At what interest rate will Marie likely be tempted to invest in Risky Mining bonds over savings bonds, assuming that the debt equity ratio is low and Marie incorporates this information in her decision making. Is it possible to calculate that number? Let's say this was a question asked on your group assignment, right? So all the other facts are the same. We concluded that Marie will not invest in Risky Mining bonds, even with the much higher probability of not defaulting. So my question is, well, certainly 14.4% interest is not enough. What would be the minimum interest at which Marie will possibly consider making that investment? I'm going to send you folks back to your breakout room You won't get a lot of time. We'll be back in possibly 3 or 4 minutes. Okay, so just another opportunity to go talk to others, say hi, exchange any contact information if you want. Let's make it 5 minutes. Okay, so I'm opening the breakout room, sending you out for 5 minutes. So just addressing this add-on question, at what interest rate will Marie likely be tempted to invest in risky mining bonds over savings bonds? Assuming that the debt to equity ratio is low and Marie has incorporated this information in her decision making. Well, so a way to make sense of this type of question is you've got to work backward and you've got to see the expected utility needs to exceed, right? So for Marie to consider investing in risky mining bonds, we'll consider investing in risky mining bonds only if her expected utility exceeds that from investing in the savings bonds. So expected utility from savings bonds is 32.62. So it had, in order for the utility to be greater, let's just arbitrarily make it 32.63, right? At least, you know, even if we make a very incremental increase, right? So we go, say, if since our calculation is supposed to be done to 2 decimal places, expected utility from investing in risky mining bonds needs to be at least 32.63 for Marie to invest, right? So this will mean a minimum expected utility of 32.63 from investing in risky mining bonds. Now Marie's got a square root utility, right? Given Marie's square root utility function, 32.63 is equal to the square root of her gross payoff from investing in risky bonds. So 32.63 is the square root of what number? The gross payoff will need to be the square of 32.63. 32.63 times 32.63. I'm going to have to square this number, right? So that 32.63 squared works out to 1065. Now that 1065, mind you, is 93.75, right? 93.75%. This one is not the gross payoff. This one's taking into account the posterior probabilities. So her gross payoff needs to be 32.63. So the square of this guy, hang on. Messed up the math there, didn't I? So square root times the 9.9375 needs to be 32.63. So if I'm working backwards, 32.63 is square root of gross payoff times 0.9375. So missing one line here, my bad. So what does that mean? The square root of gross payoff is equal to 32.63 divided by 0.9375. That works out to 34.81. The gross payoff will be 34.81 times itself. If I square this, that works out to 1,211. So since we are looking at a 1-year horizon, the interest rate is 21.1%, because 1,000 is the principal. The interest has to be $211 for 1 year. And that will happen if the interest rate is 211 divided by 1,000, 21.1%. Or if you're not using rounded numbers, it's got to be 21.14%.
So in
Or
this
20
question, sorry, the 21.1 literally equals 32.62. So would we have to go to the 2 decimal point, the 21.14?
Does it equal 32.62? I think I raised the bar here already, didn't I? 32.63. Let's work backwards. So
Sorry, it's
let's go.
32.61.
Let's double check. So if the gross payoff is 1211, square root. So square root of 1211 will be 35 or 34.81, and then the probability being 0.9375. If I multiply this by the probability, it's giving me 32.63, which beats the 32.62. So I'm just exceeding the utility from the savings. Right? I'm able to beat the expected utility from the savings bonds. The savings bonds have got 32.62. I'm barely exceeding this. Now, of course, any interest rate more than the 21% that we calculated will entice Marie to invest in risky mining. But less than that, he will not. And this is after taking account the information. If Marie was to go by her prior probability of 40% chance that Risky Mining will go bankrupt, I don't know if her investment can be won over, because the rate of interest there has to be ridiculously high, unbelievably high.